too. Just answering questions here. So Rajai, hey, thanks for the questionnaire. How do you screen for stocks that you'd want to buy options in? So, Rajai, I don't typically just vanilla buy options. I do different spreads and strategies. Usually err on the side of selling, but I do a lot of buying too. For me, it has to do with more high liquidity and potentially a reputable company. I really just look for stuff with high liquidity. I have a screener over here that's high options volume. So I use that to look. I have a couple companies I like to go back to. Like I like to trade Meta. I like Reddit. I like Coin. I'll do trades in SPY, the Qs, IWM. I mean, I'm not really too discriminatory, but it really comes down to high liquidity. It's got to be something with a lot of liquidity. Otherwise, I will definitely not trade it. Sometimes I get stuff from people in the kingdom or sometimes after hour, get ideas and use that to kind of, and then do a trade my way. And I also have a little group down here in the group analysis where a few of us discuss trade ideas, and I use that to also source ideas too. Hello, everyone. Thanks for coming in. Just answering questions. That's all this is. So you got a question, you ask it. I will do my best to answer it. But thank you all for coming. Rajai, did that answer your question, by the way? While others are typing. Yeah, you're welcome. Judd, what are your favorite and most commonly used tickers? You know, it just depends. I mean, I go back to Meta a lot. I use Reddit a lot. I like, the SPY, the Qs, IWM for, I kind of just do Jade Lizards in those. Um, let's see, what else? I mean, I like Tesla, but that's just because I have shares and I play around with them and do different spreads with my shares. Unity's another one. I have shares. I like to play around with my shares. Lately, I've been trying to like some of the futures to do options on futures. HIMS is a good one. I want to open something up in Oscar. Really, like I said to Raja, it comes down to liquidity, right, Judd? So if it's got good liquidity, then I will likely trade it. I'll trade Pepsi, I'll trade Rocket Lab, I'll trade ASTS. I haven't done a lot, but that's one I've thought about. I'll trade gold. Um, yeah, I'm not too discriminatory. I mean, I think, does that answer your question or do you have more there, Judd? In earnings, there are some stocks, this is David, in earnings, there are some stocks that don't make big moves and both calls and puts expire worthless. How can I find them? So, David, do you mean you're trying to do like a short strategy and that's what you're trying to do? Throwing a dart at the board, I think is the way to find it, David, because it doesn't matter, you're just, it's all a guess, right? But if you have some, like if you have one that you want me to talk about specifically, we can talk about it. I mean, I think it's about, like if you're going to sell for earnings, is you're going to make an earnings, a directional bet or a neutral bet, and 50-50 chance that you're right, right? And then Nacho Legend, I'm sure David answered you there. Just started, just answering questions. A couple people were asking about what tickers I like to do. You kind of came in during that, so you haven't missed anything like David said. But yeah, all this is me answering questions, so please just type them out. We'll talk about them. I got my broker open here. We can look around there, whatever. All right, Mr. Galaxy, thanks for coming. Happy to have you here. Thanks for tuning in. Mr. Taco, thanks for taking the time to answer questions. When you sell options, how do you determine direction for the week? Do you also chart the stocks or do you have your own method? If you ever get assigned during a covered call, would you just immediately get back in via CSP to wheel? CSP being cash secured. But good question. So for direction, it's kind of just a shot in the dark. You can make. I do not do technical analysis. I have some people who, in my little group down here in group analysis, Mate G, he does some technical analysis for us, and he'll tell me things. But most of the time, I'm just kind of going, you know what? It's going to go up, or it's going to go down, or I'm going to be neutral here. I try my best to be neutral most of the time, not all of the time. But it's all a dartboard. It really doesn't matter what direction you pick, depending on how you structure a trade. Your direction doesn't really matter. It just matters that maybe your underlying assumption's correct, and then you're playing with implied volatility. That's the big thing. Is hey, if implied volatility is low, we're not going to sell premium in that ticker because implied volatility is likely to expand from there. That's not going to help your premium. So it's more about looking for tickers. If it's a ticker I pick and it's got a high implied volatility, I'm more likely to do a selling strategy or have a strategy with selling premium involved. If it's a ticker with lower implied volatility, then I'm probably going to do a debit trade where I'm looking for volatility to expand, and that's going to benefit the trade. Because as volatility expands, premium increases, and then vice versa. As it contracts, premium decreases, which is good when you're selling. Now, for the covered call, Mr. Taco, I don't do a ton of wheeling. It's not my favorite thing. It's a fine strategy for some people. But I will say I had a hard time letting go of covered calls for a long time. I have a formula pinned in my channel that's an annual return on investment, so it tells you if it's worth rolling. So a lot of the time, if it's worth rolling to me, I will roll the covered call, but I don't do that too much. And then Mr. Galaxies did point out, to go back to what I look at, your TA is almost entirely the Greeks, right? I bet you can see a whole lot via the chain. So Mr. Galaxy's right, and thank you for the reminder, Tyler. I do use delta a lot. That's kind of my delta implied volatility. Delta is just a matter of where strikes I'm going to pick. Implied volatility is going to tell me what kind of trade I'm going to likely develop. And then direction, sometimes I pick a direction, sometimes I don't. It just depends. That's more of a shot in the dark because no matter what, your direction's a 50-50 coin flip. Always will be. Yes, you can maybe have technical analysis that makes you feel better. It's a 50-50 coin flip. But then going back to the covered call, sorry. So that's the hard thing about covered calls. As I had stock that I held for a long time that's in covered calls, I'm a little less confident to just jump back in with a cash secured put because it's like, well, it feels overvalued to me. But if you're going to go for the full wheel and you feel good about the stock, there's nothing wrong with jumping back in with a put and just keep on going. I don't. The thing I don't love about the wheel is that, hey, if we get into a bear market, you get assigned the shares, and then you're not able to open that covered call, which can kind of be a bummer. So, Suicide Baptist, what deltas do you usually shoot for? Depends on what we are doing, but let's just use a vanilla wheel example. I do not go higher usually than 30 delta, maybe a 35, but I prefer like a 15 to 25 delta. And depends on the strategy, depends on what I'm doing, but I like that 15, 25 kind of as a sweet range where premium's still sometimes good. It depends too, right? Like if I want to sell a put and I have to go to 30 just to get a decent return, but I feel good about it, then I'll do it. But otherwise, I try to go in that 15, 25 range. You're welcome. You're welcome. the big thing, I know Suicide Baptist, you wanted to talk about the wheel. The main thing I look for in the wheel is a 2% return on my collateral. So if I'm selling a cash secured put that's fully cash secured, 2% of the strike times 100. If I'm selling a covered call, 2% of my cost basis on that stock. That's what I do. It's very conservative. Yeah, of course, you're welcome. Thanks for joining. So anyone who came in late here, or you haven't been here, just answering questions. I think Mr. Taco, by the way, did I answer that sufficiently, or do you have more there? And then anyone, just pop in a question. Maybe you saw a trade I alerted. What the heck were you doing? Whatever, I'm here. No dumb question here. And good to hear, Mr. Taco. No problem. Because literally I have nothing planned here. Um, Sometimes I have a subject plan. This time I had nothing. So, I mean, you could even, yeah. All right. Well, thank you, Blaze Ray. I'm happy to hear it. Um, you know, uh, so Tyler, how much margin do you use? I see some of these trades that are naked, at least partially, and that really scares me. So I would say of my buying power usage, I'm in about the 20% range. You definitely don't want to go higher than 50%. I'd say 20, 30, 40, 50%. Right now, this is new to me for the way that I'm using buying power and being more explicit with it, like seeing the number. So I'm just kind of starting out with 20, but I have a decent amount that if things go wrong, I can continue to manage the position and not get a margin call. And that's the important part, because you want to stay small with that. And yeah, naked is a little scary, sure, but I feel like I would much rather, I feel pretty confident in naked puts. Naked calls, not so confident in. That's why you see me doing like Jade Lizards, where the upside's capped, but the downside's not. The if we just look at markets in general over time, the market in the last 50, whatever, how long the market's been around, let's say 100 years, the market's gone up, right? So even if we have some stress to the downside, eventually it will go up. So the point is to size yourself small so that that naked put, you can continue rolling and managing until hopefully it goes out of the money and you don't have too much buying power being used. But I do understand, Tyler. I get you. I get you, Mr. Galaxy. It is a little, I wouldn't say nerve wracking, but it can get your attention. It's important that it gets your attention. There's nothing wrong with that. I mean, it's all about risk management, right? For Nacho Legend, for the wheel, 2% per time I open the contract. So for me, when I do the wheel, this is different than everyone else. I know Theta Daddies does like weekly, great for them. That's cool that it works for them. I do 30 to 60 DTE when I open up the contract, so I'm going for about 2% a month, roughly. Okay, so you know the probabilities on it, and you have comments before taking those trades. Yeah, usually. I mean, so like, let's just use Tyler. Do you have one specifically, Mr. Galaxy, that you're referring to? I mean, are you thinking of like the Jade Lizard on spies I've done or stuff like that? Oh, that's a zebra. So Tyler's saying, or Mr. Galaxy, sorry. Yeah, which is that two sold options and one bot? Is that a Jade Lizard? So actually, the other way around, it's two bot options and one sold. By the way, so it's actually a defined risk trade. It's not naked. You pay a debit up front, and that's the defined risk. So like for example, I opened one up in ONS today. I bought two of the 5 strikes, sold one 750 strike. That cost me $370. Um, so that's one. That's defined risk though. That's the max loss I have on that trade. But I don't know if that's the one you're referring to. So a Jade Lizard, just to show you, because I almost did one today, and I should have, because I would have been able to exit it, most likely. So Jade Lizard, it's a little wide here, but Jade Lizard is selling. You can do it two ways, but we'll go with the put example. You sell a put, can be not cash secured. In this case, it would not be, but it could be. You sell a put, and then at the same time, you sell a call spread, call credit spread. And the goal here is that you want this. So we actually wouldn't do it here. We'd probably do it here. You want the credit received to be greater than the width of this spread. So that's a Jade Lizard. Yeah, I mean, so that's the thing is that I play with this to make sure I like what I'm seeing. I'd probably go, yeah, 20 is probably going to be the highest. This is 21. I mean, maybe I would probably prefer the 18. eh, And I could even go to like the 16 here, but then I have to play around with the call side here because I'd have to probably do something like that. So that's another option. But yeah, the reason I feel confident is just probability standpoint of, yeah, basically exactly that. It's enough out of the money that I feel like it's low risk. Like, and then look at like 610. When's the last time we were at 610 in SPY? Yeah, June 26th. I mean, feel pretty confident if I was to submit this order that I would probably not be tested. Plus, this blue dotted line is one standard deviation away. So there's a 68% probability that you're likely not going to hit that number, right? Um, far outside of the expected move too, which is this orange bar. Do you know Taste Trade's requirements to make this trade on margin? No way I can afford a 620 CSP. With Tasty Trade, I don't. I think you just have to fill out their questionnaire, and they can give you everything if you want. They're not very limited. Um, what do you have with them right now? Like, do you know if you have the works or whatever? Because I have the works. Yeah, I don't know if do they call it level 4. I don't know what it is. They call it the works, I think. And that's what I have. So that's why you see like my buying power effect is $5,400 instead of 60,000. No, $61,000, right? Well, minus the 4.7. But anyways, this would be your buying power in Robinhood, let's say, right? Which is, yeah, I don't have that buying power either. I wouldn't feel comfortable having that much buying power in one position. Yeah, so that's a good question, Tyler. So Mr. Galaxy, so what I say, and this is from Tasty Trade, and I follow this for the most part, is with you want to do about 1 to 3% of your portfolio or buying power in defined risk. So just do 1 to 3%. So that means if you have a $100,000 portfolio or a $10,000 portfolio, then you're looking at $100 to $300. And then for undefined risk, which a Jade Lizard would qualify, you go for about up to 5%. So if you have a $10,000 portfolio, we're talking about 500 bucks. Um, and then, of course, when you have a smaller portfolio like that, you wouldn't necessarily do a Jade Lizard. You would do an Iron Condor, or a put credit spread or a call credit spread. which are defined risk trades. You can be a little more liberal, but yeah, I mean, you want to go for like, yeah, you are welcome. No problem, Mr. Galaxy. Happy to answer it. Hello, yeah. Anyone coming in? I'm just answering questions here. Nothing set in stone. Your questions drive this. That's all I'm doing. Mr. Galaxy, too, if you have questions outside of this or anything, we can talk about it. Like if you're even like, hey, I want to go neutral here, and I have this much money. What can I do? We can talk about it. See Neil typing. We'll wait for that. But anyone else, please feel free. Any questions? That is what I'm here for. Oh no, that's fine. Yes. So, cash account. So you can't do level 3 options. Is that correct with a cash account? Oh, you can. Okay. Um, yeah, I mean, so obviously, would you want to, worst case scenario, sell some of those shares or no? Okay. Yeah, and so let's just say if you have $100,000 with Nvidia, let's say you only open a covered call on one, let's just call that 500 shares, or I don't even know what it is. It's not 500, is it? Let's say you have, let's just say you have 200 shares of Nvidia, okay? Well, instead of opening covered calls on all of them, maybe just do one lot. But what you can do with that is you could do you could do a Jade Lizard backwards Jade Lizard. They call it reverse Jade Lizard, which I do open. I have one open in Tesla. But if we look at Nvidia, just to show you, let's pretend like you were okay with having covered call on one shares. You could pick like a 20 delta and sell that, and this would be your covered call side. And then you could, now it's not going to be great, but you could, I don't think it's going to work well. Yeah, you probably have to go up here. Yeah, I don't love the Jade Lizard here. I mean, you could route something like this, very narrow though, for you to be profitable. The reason you want to make sure that this credit received is greater than the width of these strikes. Um, IV is pretty low here, so it's kind of hard. Something else you could do is a call ratio spread, depending. And so if you did something like this, you have a built-in debit spread here and then a covered call on top of it. So your max profit's the credit received plus 500 bucks or the width of the spread. That's another thing to do. And then another one which I like to do to generate some income is a covered strangle, where you're covered on the call side because of your shares, and then you just have this put side. So that's another way, and then you can do that with Microsoft too. Something to be aware of though is implied volatility is low. So it's not a great time for you to sell options on NVIDIA. I mean, you look at this IV rank of 4, not great. And we look at Microsoft, wherever the heck they are. I don't think Microsoft is much better right now. 22% IV rank. Yeah, so same thing. But that's a way for you, and we can keep asking questions, Neil. But that's a way for you to make income on those shares and do more than just a covered call. Like you might as well build in some extra income potential and premium potential in there. Yes, AVGO Tesla app. You definitely want to do them in higher IV environments because it's better to sell premium in high IV because implied volatility is mean reverting, which means that if it is high, it is likely to contract, which benefits you from selling premium. Whereas if it is low, an IV expands, like Nuke just said, it hurts you. So you don't want to sell premium in a low IV environment because as it expands, even if you're directionally correct, you could be losing because of that implied volatility expanded, which made premiums increase. But I mean, just to look at Tesla, just to show you, and I've been rolling and playing with this, and because I have shares in Tesla, I don't want to sell them all, but I've been playing with them. But like right now, I have a Jade Lizard on in in Tesla. This is my Jade Lizard. Getting a little tested on the call side. We'll wait and see. I've got a good amount of premium collected in this position so far. I've collected $12.11 thus far. Um, so, lots of premium means my break evens are pretty wide on this right now. If we take that out. So my break evens, three, almost 400. So I'm pretty confident on the upside. I also rolled this out from a call ratio spread. So I still have the call ratio spread. So another $500 baked in here that I could potentially get if we go past 360 by September 19th. So there's fun things you can do to kind of just play around with shares. Um, does that answer your question, Neil? But you definitely want to eye high implied volatility. Now Tesla, it's a little low right now, but it's not a bad one. Premium in Tesla is usually pretty good. I mean, 50, 60, it's still lower. It's not terrible. I mean, we're in a low implied volatility across the board right now. Um, but yeah, AVGO, yes, okay, welcome. And yeah, please, any more questions, feel free. Um, so if no one else has anything, it doesn't look like it. Suicide Baptist was terrified of AI. I don't know if anyone saw this on After Hour, talked about how you should do a poor man's covered call in AVGO. Suicide Baptist was interested in this, but didn't really understand it fully. So I can talk to you about this, Suicide Baptist. Personally, me, I don't love poor man's covered calls, mostly because you limit your upside potentially. So like, let's just pretend I have a leap. I have a leap on Google. This has worked out very well for me, and I'm going to continue holding it for a little while. But I have a leap on Google. Okay, I bought this. This not 90 days is wrong, but I bought this a while ago. If I had short calls on this, I would have capped my upside. Now, you know, it depends on how much money you have, what you want to do. There's nothing wrong with capping your upside. It's just not my favorite thing. But yeah, exactly what Nuke just said. It's like cool in practice, but then I mean, what's AVGO at? Well, let's just look at Google. Let's just say I had a covered call on this leap at 220 and it was doing fine until this news came out. It shot up. Well, then I'm like, well, man, I could have had 7 grand. Now I've got 5 grand. You know, so it's something to think about. But we can look at it, Suicide Baptist. I'm happy to structure and show it with you. But exactly what Nuke said, I've been burned by covered calls so many times that I'm really hesitant with capping my games in covered calls unless I'm going to be playing around more. Where it's like this Tesla. I have more than just 100 shares of Tesla. Happy to play around with 100 shares. Unity, I have 500 shares. Happy to play around with a few of them. Also in a stock like AVGO, I don't know if you can even call it poor man's. It's true with AVGO. AVGO is a rich man's covered call. So and then we'll look at it, but like it's like how much are you really decreasing your debit paid? It's like you're collecting pennies to reduce that. I just don't know if it's worth it, but we can look at it. I'm I'm not everyone feels that same way. There's something wrong. It's just knowing what you're entering into, I guess, is the important thing here. I'm starting to realize that cover calls are good. Sometimes, like when it's sideways or going down, help recoup losses from downside. But if it's going to pop like SoFi or run, not good. Yeah, and the hard thing is you don't know when that's going to happen, Nuke. That's the hard part. And that's fine, Suicide Baptist. We'll still structure it. We'll look at it. Um, and then, like Mr. Galaxy said, a synthetic long position is another option. So Suicide Baptist, we just to look at AVGO. Let's just pull it up. Okay. Now, let's just say, where would you, what would you buy and what expiration, Suicide Baptist? We're just going to go through a few things here. But Mr. Galaxy, great one with synthetic long because that's a good, very low. Assuming he has February, March 26, Jan 2027. Okay, I would go. Yeah, so terrified of AI was saying like 100, like less than a year. I definitely would go for at least the 350. But yeah, if you want to go January 2027, that's fine. More time, the better. It's just gonna be more expensive. What would you do when I look for leaps, a poor man covered call? I go for a 70 delta. I go for a 70 delta. Why? Well, it is more expensive, but 70 delta means that you have a 70% chance that this is going to end up in the money expiration. Plus, although delta is dynamic, for every dollar increase in AVGO, you're getting 70 cents increase on this contract. Now, as time goes on, this delta is going to increase, of course, if you're directionally correct. Okay, so he said 2027. Yeah, that was his poor man's IDK would recommend for a synthetic. Yeah, and we'll look at synthetic too just to compare it. So Suicide Baptist, would you go for a 70 delta or what would you buy if you were looking at this options chain? It's okay if you're not going to buy a 70 delta. The 70 delta is $9,000. Not a lot of people are going to feel great about doing that. And that's okay. You have no clue. That's okay too. Well, here's the question. Ooh, I don't know if you're going to want to answer that in here, so I might not ask it for you. I was going to say, how much would you like to spend? But you might not want to answer that today. Hey there, Tran. Thanks for coming in. Let's go off the 70 delta. Okay, so let's just pretend you're going to buy this January 15th, 2027, 290 call. It's going to cost you, let's just say $9,170, right? Max, wait, I sold this and not bought it, excuse me. So max loss is that debit paid. Your max profit's infinite. So then we could start looking at selling covered calls against that long, right? So if we look at, I would go out to October. Now, what you have to do is you have to consider that you've paid this much money on top of what strike you're doing. So you're doing the 290 strike plus 91.7. So technically your effective cost basis is actually $381. You would not want to sell a covered call below this because if you do, in my opinion, you're losing money. But that's just me. Because if this was to get called away and you picked a 350, well, you're losing 40 bucks, in my opinion. I could be wrong. But let's just pretend then you'd have to sell the 390, right? So if you sold the 390, that's an 11 delta, very far out. I mean, you could sell the 380. Let's sell the 380 because this is going to reduce your debit paid in that you will be at, what, 378.17? Yeah, 290 plus 88.17. Oops. Yeah. Whatever. It's 378. Anyways, so you could sell this. And so then you go ahead and do this. This effectively reduces your cost basis. If AVGO, if you get to a point where you're happy with closing this out, you can buy to close this later and then keep on rolling it. Now, that will continue to decrease your debit paid, your cost basis. And then the way I would determine my 2% in here is I would say, okay, I spent 91.17. Is that what we said it was? Just a second, sorry. 91.70, excuse me. 91.70. I mean, you'd hope to get $1.83 out of it in premium, which if you're at the 380, you're getting that. So that would be what you were doing. And then you keep on going, keep on going, keep on going. So that is an option. Another option, like Tyler was talking about, is a synthetic leap. Now, or a synthetic long. Now, for the synthetic long, we can go a little further out in time. I mean, we could look at this January. Let's just look. I wouldn't probably do this just because you're going to be tying up capital for a while. Yeah. So this is not, January 27 might not be great. Let's look a little shorter data. Let's just look at October for now. So the nice thing about a synthetic long here, and what a synthetic long is that you're buying a 50 delta roughly call and selling a $50 put at the same time. This makes you long 100 deltas synthetically. So not only do you have to pay no money to open this position, you're going to receive 400 bucks to open this position, and all you have is your buying power effect and or cash secured, right? So that is an option to look at, Suicide Baptists. And then this way, let's say you get to a point where you've made money or not, you just roll this out and keep going. It's an option. The poor man cover call is not bad if you have the money and you want to do it. I just don't know if I would sell calls against it. So Hood went on the S&P, huh? Wow. Well, that's why Blaze Ray was getting all excited. Strike distance has to be more than premium paid for the long. Strike distance has to be more than premium paid for the long. I got AMAG lead from 1,000 to 300 from the strat. Sorry, 700. Okay, but you got 300 in premium. Okay. Um, would that give you the same benefit as owning 100 shares, or am I understanding that wrong for the synthetic? Yes. So the synthetic, and I'll get to your Mr. Galaxy. Yes, synthetic, it depends on how you structure it, Suicide Baptist, but structuring it this way, you are long 100 deltas. So you are long 100 shares of stock. This means for every dollar increase, you get a dollar gain. Now, of course, it's dynamic, so that's going to change. As it goes deeper in the money, this number is actually going to increase. As you go out of the money, it's going to decrease. But yeah, you're basically synthetically owning 100 shares for no cost up front. What does Taster say you need for buying power margin? So yes, so Tyler, you would have to have about 5K. This is for October. I mean, you can go further out. Like if you wanted to do a little bit more like a leap, but not quite, you could do December maybe. Although you're going to tie up some capital for a while, which is the only disadvantage. Less money today, a little more buying power, but you're still long 100 deltas. Gives you more time to be right. Yes. Yeah. No, the synthetic long's great. A zebra's great too. But the synthetic long is nice because you are paid today. And you can do a synthetic short. You gotta do a naked call if you're gonna do that. But you can oh, and let's say you're in a cash secured account where you have to cash secure your puts, you can negate that by synthetically capping this. It's going to cost you a debit or a lower credit, but you can buy like a 5 delta put, which will lower your buying power. You know, instead of 5,000 in a like a Robinhood, you're going to have to put up 12,000. But it caps your loss, and then of course, if you wanted to go synthetically short, where you do the opposite, you can always cap your downside by buying a call over here, or excuse me, the upside. Those are fun things to play with. Yes, yes, Suicide Baptist. A synthetic long would be buying a call, selling a put at the same strike in the same expiration. Um, Another one a lot of people do is called a risk reversal. And it's another one for you to consider is you could buy you sell a put wherever you're happy with. Let's just say you sell this one. And then you buy a call. I mean, maybe you have to go a little bit higher up, but you could go like 330, let's just say. And then you can buy like the 360 where you're getting a credit, or or if you go 350, you have no credit or very little credit, and you're about 90 deltas. This is another way to structure it. A little lower strike. That's called a risk reversal. At what point would you recommend rolling that? So, for me, I usually roll around 21 DTE. You could roll the 14 DTE. Yes, Nuke, I'll get back to that. You can, yeah, you can like roll around 21 DTE, and so then for the rolling is if it's the synthetic, we'll go to the risk reversal. Don't worry. Then you could just buy to close, sell to close, and then open it up in the next expiration. But yeah, I look to roll around 21 DTE. You can also evaluate if you just want to take it off and open a new one later on. So that risk reversal, Nuke, is you're buying slightly out of the money, and then you're going to sell a put to finance it, basically. So, you're selling this put, it's going to finance you to buy the long. It's a little less deltas, but lower strike on the short, so you have to use a little less buying power. 90 deltas, dollar credit. Is that enough there? Yes, that's the great thing about options is it is leverage and extremely flexible, which I love. Is the possibilities are only as endless as our own limits. I said that wrong. Our possibilities are only limited by our own limits in our mind, basically. I mean, you can even do um, Nuke. I will get to that question since Suzette Baptist still. If you went with that route, would the call you purchased account for the shares if you put against exercise? I would imagine. Oh, if you went with the risk reversal here, or the synthetic long. Yeah, so like yeah, I guess that's a good way to think about it. I mean, the problem is that it's in the same expiration, but yeah, if you got to sign these shares at 3:30, and let's say there was still time left in the contract, then yeah, oh no, you're buying the shares, you're not selling them here. So no. But then you own the shares and you can open a covered call later on. So Nuke, even at 21 DTE, if it's a big loser, say negative 100%, would you let it try to expire? Yeah. Um, so here's the thing. I got this Apple trade that I screwed up. Majorly screwed up. Had a zebra. I panicked. I changed it up. Then Apple had a huge run. If I left the zebra, I would have made money. But I flipped it to bearish because I got nervous. And so as you can see, it is down to almost zero. So yeah, I'm letting it kind of see what happens. Hopefully I get a nice down move and can get out for less of a loss. A lot of the time when I open a defined risk position, I'm opening it knowing that the max loss is a real possibility, and I kind of treat it as my stop loss. Now, sometimes I'm going to get out early if I'm like, you know what, the loss is low, let's just get out and re-enter. Something I should have done with Apple, but I panicked and then was just sitting with it. But hey, we're learning lessons. I'm not perfect, okay? And this loss is going to hit my alerts. It's going to be a bummer, but it's not that big of a deal. At the end of the day, I've made more than this is going to lose, luckily. But it happens. We're not perfect. And my lesson was that if I trusted myself more and let it ride, I would have made the money. And I allowed for that max loss to be a reality before, I would have made the money. It's hard. I mean, like another thing is I had a crude oil iron condor on. I took it off for 50 bucks. Not much more, but I could have closed it out today for 50 more. But I didn't like where I was going. I was getting within 14 days to expiration. It wasn't really worth it for $50 for me to sit in there. All right, Nuke, no problem. Thanks for coming. See you on Monday. Have a great weekend. Hey there, Fonzie. But yeah, Suicide Baptist. Any other questions with AVGO? I want to make sure to help you there, since I told you we can talk about it later. And this is a fine time because unless anyone has questions, Fonzie, I don't think you've ever been here. All I'm doing is answering questions. So if you have a question, type it out. Yes, you have not. So all this is me answering questions. So if you've got questions, type it out. I have nothing planned, so just let me know. No, that's perfect. I don't think I will go that route just due to the premiums. When you say go that route, excuse me, do you mean poor man covered call? Yeah. Yeah, I think synthetic long is a good option, which I sometimes forget about, because you've got several options when you want to go long on a stock like that. Hey, I understand, Fonzie, no problem. But feel free if you got questions to type them out. Right now, Suicide Baptist is talking about mostly AVGO and other things that are coming up. Would you recommend synthetic long on something like ONS just to tie up less capital, or is it buy shares better for that? So with ONS, um, it's a cheapie. So period, you think about it, let's just look at ONS, right? Cheap stock. You can buy 100 shares for $564 today. Or like what I just opened up today, you could do a zebra. I did a long-term leap style zebra, which I've never really done before, but I thought, you know what, I'll do it. I spent $370. Not huge savings, but it's a fraction of what I would have paid. It's about 2/3 of what I would have paid if I opened it, if I just bought the shares. Obviously, you could just do a leap in here. You could do the synthetic long, and this is a good option to do a synthetic long because the IV is so high. And that's why I went with the zebra and such a far as the IV is kind of low in this, relatively low. I mean, you look at this, it's IV rank of 11, and it's at 100%. But if we look at let's just go to December, and we'll look at the synthetic long. So, hey, $37 credit, you're tying up $500 in buying power because this is cash secured. I mean, it's not a bad option. I mean, technically, you're tying up exactly the same amount of money it would cost to buy the shares today. And because there's high IV, it's good for the selling of the premium. So I'd say with ONS, it kind of like something cheap like that, it's up to you, right? Good question, Fonz. So Fonzie, not sure if this is something that would make sense here, but app just got added to S&P and jumped 35 points after hours. Is this an overreaction, or does being added to S&P that significant? I mean, who got added to the S&P not too long ago? And they ranked, Coinbase. So we look like Coinbase, just to answer your question. I'm not a professional here, that's for sure. But if we look at Coinbase, forget when Coinbase got added. Was it back here? When did Coinbase get added to S&P? Was it around here? I think it was around here. But you look at it, I mean, it jumped up, it went down. Of course, it was April. I could be wrong. This might not be December. Does anyone remember? It doesn't matter. But I'd say that I think in people's minds, it gives it significance, that it gives it reputation to the company. I'd say it's going to jump up maybe initially, then it's going to probably come back down to earth for a little bit. Might not be a huge reaction or correction, but I think that May 19th. Okay, May 19th. Thank you for that. So yeah, okay. So around here, I think there was discussion of that. And so they did jump up. 231, traded sideways, went down a little bit, but it's gone up since then with after earnings and stuff, and then crypto, and then it's been trading sideways. So I mean, it didn't correct too much. I mean, it's been above that as an example for them. Yeah, so I think, is there, are you just asking Fonzie, or do you have something like a put on an app or something? Yeah, just asking. Yeah, I think it's not necessarily that significant, but I think it gives traders a sense of reputability. Rep adds to their reputation. I don't know why I cannot say that word. Oh, you're flipping puts on them. Yeah, I'm surprised they got added to the S&P, but hey, I kind of like them. Also, I sold a couple weeks cash secured put a couple weeks back for Robin and was down bad. In instances like that, would you recommend rolling it? I'm curious the best way to handle that situation. I'll read the second part of your question. Yes, I would recommend rolling it if it is profitable to do so. I've been doing cash secured puts a lot to tie up less capital, especially for things like Reddit. Is this a good way to go about it? Granted, I'm doing large spreads, shooting for as close to zero cost on the put as possible. Is this bad practice? Here's one that expired today. So you're doing put credit spreads? No, I mean, so the only thing I would say now it's hard when you go this wide, but if I'm doing like a put credit spread like that, I look to receive a credit that is 1/3 the width of the strikes, roughly. And if you look here, you received about 1.5% the width of the strikes, right? Is that right? Not 1/3. No, no, no. Sorry, you were like 10%, right? Because it was can't do math in my head today. We'll just say it's 330 divided by 40,000. Yeah, you're getting like I don't know what this is in times. Yeah, whatever. I don't know what fraction that is, but um, I try my best. My breast. Oh, PCSs. Sorry, I see there was a typo there. That's why I was confused. Yeah, I think that what I do is I try. Yeah, no, no worries. I try, like I said, I try to get 1/3 the width of the strikes. As you get wider and wider, though, as you see in this, it's harder and harder to get that third of a width. Like you're going 40 wide. I mean, it's kind of hard. You're technically just doing a synthetically naked put in this, in my opinion, here, because you're really not. So I mean, there's nothing wrong with doing that. You're capping your downside worst case, especially if you don't really want to buy the shares. You're capping your downside here. Um, but I would definitely recommend rolling it. Now, if you're going to roll a put credit spread like this, what you don't want to do, and sometimes you have to do, what you got to be careful about, is you do not want to increase the width of the spread as you roll because you're just increasing your risk and it's usually not worth it. So, like, let's just use that one as an example. You would have to maybe roll out to the 220 put and do the 175 put. I wouldn't recommend it. You're increasing your risk by $500 and probably not receiving a credit substantial to that increase of risk. Oh, you did this for a weekly. I got you. So then, yeah, you're definitely not going to get 1/3 of the width in that. In this case, um, I always go 30/60 DTE. That is not from other people I've seen on After Hour. In this community, it's a little bit different because no one really does spreads. But people I've seen on After Hour, people don't do further dated stuff. People like the weekly stuff. I do not like weeklies. More time for you to be right if the more time you give yourself in the contract. Hey there, bread boy. Thanks for coming. I don't think you've been here before. I just answer questions. So Suzette Bapp's asking a couple questions right now, but yeah, all of it this is driven is your questions. So if you got questions, shoot them out. Yeah, I'm just trying to understand if that is too risky with that large of a spread. Just trying to collect as close to a full premium as possible without tying up 20K in capital. Great point on the weeklies, though. Yeah, I mean, like, let's just look at Reddit right now, just to show you, and we can structure something very similar to what you just did. So we go to October, and you do the 220 and the 180. So you got a 68% pop. You're receiving $844. So if you look at, it's not, it's 40. No, it's 4,000. So you're getting 20%. You're not getting quite a third or a fourth, but you're getting a little bit more. I mean, you could always structure this a little bit differently, but it makes your break evens higher, So, you could go to, you think about the expected move here, right? So if you wanted to still sell the 30, you could go like, 20 wide. Okay, I'm getting 20 wide. I'm getting not quite a third, but closer. That's the only reason why I like the further out. Pop 65, still pretty good. That's just me. The reason I like further out too is for your point of rolling. If it goes against you, you have time to roll, and I roll around the 21 DTE. Do you have an expertise or area you teach in, or just general stuff for this? So, Breadboy, I don't know. I think you're relatively new. I don't know if you watch my alerts or anything, but I normally I do spreads a lot of the time, sell options. So that's kind of my expertise is I don't do technical analysis. I don't, look at charts all day. I'm more looking at implied volatility, deltas, um, liquid tickers. That's kind of where I'm going. Yes, I am Parunga. I just changed my name to Ryan because I felt like I didn't need to be Parunga anymore. So Susan bet this. So in that case, I'd be better off just buying more contracts for the same amount of tied up capital, and then you'd actually be ahead of just doing a single contract with that larger spread. Am I understanding that correctly? Oh, yeah. So I think Fusai Baptist to answer, um, yeah, to answer your question, I don't necessarily err on the side of increasing contracts. It's actually better to increase the width. So yeah, like if you want to tie up $4,000, then it'd be better to do this than two 20s. Okay. Tasty actually did a study on this, and in that most environments, this is better for you. However, in like good environment conditions, quote unquote, increasing contract size is actually better. But how are you going to know if it's good time to do it or not? So it's actually better if you want to do $4,000 of buying power for you to do this than two of the 20 wides. Yes, Bread Boy. I tried my best to let everyone know that I changed my name, but things get lost. You just think I'm doing regular dumb alerts. Yeah, of course, Suicide Baptist, no problem. Happy to help you out. But yes, I did state it here, Bread Boy, but no one probably saw. I said, where did I do it? Yeah, updating my name here. I'm Ryan Parunga. Yeah, this is me. Anyways, I guess I didn't say I used to be Parunga. But yes, it's okay that it's confusing. It is me, the same person, just not using a pseudonym. Using my real name mostly, my nickname, I guess, and my real picture. And Suicide Baptist, if you have any other questions, please feel free. This is all we're doing out here is answering those questions. Hi there, John. I don't believe you've attended before. Just answering questions. So anything you got, feel free to shoot in the chat. Oh, Bread Boy, I don't know what historically happens. I will say recently what's happened is the stock shoots up. I mean, we look at like app is what everyone was talking about, and then hood. What was another one that got added? Did MSTR get added? Yeah, so it's at 523. It was at 490 at close. What did hood do? Up $7. I don't know why a hood's $100 stock, guys. I'm sorry, but I own shares, so I'm not upset about it. But I don't know why it's $100 stock. Like obviously there's the pump, but generally stability falling seems like it makes sense. Yeah, I think Tran was just talking about Coinbase, or excuse me, Fonzie was asking about this. I think he left, or they left, and I was asking about Coinbase as an example. And we look at Coinbase, because they're one of the few I remember recently getting added. And we see like around here, we see a pop. They got added to S&P, but then since then, they have not dipped below that gap up. So, it's worked kind of well for them. They have the stability going forward. I have a zebra for coin in October. What strikes did you do, Tran? That's very that's very bold. Hey, it wouldn't have been cheap, but hey, you never know. Hope you didn't spend 4K, but you could have. 340 and 310. Ooh, yeah, not great, huh? Obviously, you could roll it. You could roll it, close this out, and open maybe like a 290, 300 or something. You could try rolling it with these just to give yourself more time. Yeah, Coinbase had a big correction, unfortunately, after their earnings, and then they trade sideways. But people on After Hour are saying that they're expecting it to pop up. I don't know. For the put credit spreads, do you ever close out just one leg, or do you close them all out together? I understand that liquidity is a lot thinner trying to close out the spread, or would you ever recommend just rolling out the short put instead of the long put if you were getting beat up on the option or vice versa? Yeah, so I don't try to leg out, although I've heard, sometimes people do leg out. I mean, if you can leg out and like, I would assume if you were going to leg out, would you leg out the long or the short? I usually close them together to answer your question, but if you were to leg out Suicide Baptist, like let's just pretend you have, let's just go to Reddit again. Like let's pretend like you have the 221.80. How would you leg out of this? Isn't legging out the short safer? Well, I mean, yeah, technically, because if you leg out the short, you're just going to increase your debit, and then you could benefit from this. It depends on where the stock's at, right? Um, hey, you're welcome, Bread Boy. Thanks for stopping by. Um, you too, you too. See you on Monday or tomorrow. If guys have, we have trivia tomorrow. If anyone wants to join, me and Fridge are going to do trivia. Um, Tomorrow at 1 p.m. Eastern, trivia in here. You can win a free month. It's like 20 questions. We use Kahoot. Um, yeah, Tran won last time. We did it about 2 weeks ago. Topic's going to be random. I did 10 questions. He did 10 questions. So, my questions are going to be, my kind of stuff, and his questions are going to be weird economic data stuff. But yeah, yeah, welcome to join. Anyone is welcome to join. Please come on through. It'll be fun. Sorry, Suicide Baptist. We will answer your question. I promise. Hey, that's what I try to do. I try to make them a little tricky. But I'm glad that you hear they're not too easy. So, put credit spreads. I have, like I said, I've never really legged out of the put credit spreads. We'd have to look at an example and talk about it and see what you're looking at. Um, and then, yeah, I mean, definitely an option is instead of rolling out, if you were comfortable with it, instead of rolling out a spread, you could figure out what the heck. You could figure out what you wanted to do with this and then just roll the short, maybe. Um, and then leave the long. I mean, then you have some income potential there if it does keep going down. Definitely an option. It's hard to talk about esoterically until we see like I see an example in front of me. Um, yeah, I don't know if I'd roll the long out and leave the short to answer your question there. I mean, the one option too is if you were like, you know what, I'm happy buying the shares, is you could sell to close the long and then just continue rolling the put, or um, or just accept assignment and let it sit. That's another option. I know one member in my trade discussion group, which anyone's welcome to come in here and talk, by the way. This Ryan LP's trade ideas and discussion under group analysis. We discuss trade ideas, look at things, but one member here, Rolling Sushi, was doing, forget what he did exactly, but he opened up put credit spreads and his intention was to buy the stock. So exactly what you said, he would sell to close the long if it went against him and then just accept assignment of the shares. Okay, I'm happy to have tricky questions though, Trey. I'm happy for it. That's good feedback. I'm glad you said that. I'd rather that than easy questions. I mean, you only have a minute to answer them. It's pretty quick. Definitely don't have a current example. Was battling that decision on Monday with one that I've since been able to close out. That's good. Good to hear. Last question, I promise. Hey, you can ask as many questions as you want, Suicide Baptist. Please don't worry about it. Other people could chime in if they want to, and they're not. So don't worry about it. But hey, yeah, Mr. Galaxy's gone, but Mr. Galaxy, Naomi, Blaze, Ray, Tran, Etai's definitely not here. But any of you guys got questions, throw them out there. I'm good though, Suicide. But I followed the trade a few days back and I'm getting beat up on it. What would you recommend doing with this if it were yours? I'm just going to wait it out and accept max loss if it happened. Curious what you would recommend doing. Yes, so it's a long. Um, I mean, you look at it, you spent $224. You already lost 80% of this. First off, whoever it is, you need to go beat them up. That's a joke. Um, but I would say kind of up to you. Either you could walk away, take 20% off of this, or accept 224 as your max loss and see what happens. For Microsoft to be, yeah, you had a pretty rough move today, huh? Very rough move today. Yeah, you'd have to have a pretty nice move to make money out of it. You could always sell. You could always turn into a vertical. Oh, probably not worth it today, huh? Let's see. If you turned it into a vertical, what are you at? 9, 12? Yeah, 520. You could sell the 520, but you're going to get 20 bucks back. It's not really worth it. So that's something you could do is you could turn into a long call spread and reduce your loss. Of course, to cap your gain, but I mean, obviously, another option is to roll it out if you want to double down. You could roll it out to October. Um, yeah. Hey, Tran, sorry, did you get the month figured out with China? I want to make sure that worked out for you. Controversial member of After Hour, huh? Don't worry about it. You want to follow stuff? You want to follow stuff. It's no big deal. $224. I don't know what your account looks like, but pretty small risk on the grander scheme of things, I'm going to guess. For the long call spread, I would just sell a call slightly above where that one was, correct? Yeah, so I mean, you look at the 515, you spent $2.24. So let's just call it well, no, let's call it. It's 517.24 is your break even, as it says here. So, if you sell the 520, that gives you at least you're going to have the 515 plus the 2.24 minus, let's just call it 0.27. And then if you do 520 minus 516.97, your max gain is 303. your max loss is going to be 197. So that's something. Hey, Tran, yeah, have a good one. See you later. See you tomorrow afternoon, maybe. Well, morning for me, but afternoon for people on the East Coast and whoever knows for international. Have a good Friday night. Does that answer your question, Suzette Baptist, with the spread? It's just a way for you to reduce your capital if you wanted to. I mean, it's hard because if you sell that short, it kind of gets harder to make money out of it. Whereas if you just had the long call, you might be able to get money sooner. But it's up to you on what you want to do. I mean, you reduce your loss by a little bit, but it's 20 bucks worth it, right? Thought of, do you typically set stop losses right out of the gate when buying selling options? So I not too concerned with the max loss. That's good. That's two answers my questions. When I set up defined risk positions, I usually accept the max loss as my stop. I don't want to play the game of, oh my gosh, it's down 20%. I could lose it all and then it bounces back. My goal is if things start going against me, I'm going to look to hopefully close it out for a scratch or a small gain or a small loss. But yeah, usually my stop losses, I I typically don't set stop losses. I treat my max loss as my stop loss. But that's why it's important to keep it small. Like if this was a $2,000 position, you might be really hurting if you went for your stop loss, right? But it's a $200 position. So, you know, assuming based on what you're saying, I'm not too concerned with this one, 200 bucks is not going to hurt your account. But there's nothing wrong, to answer that question too, there's nothing wrong with setting stop losses if people want to have stop losses. I know like Royalty uses stop losses. I know David Knight uses stop losses. Nothing wrong with using that, not judging anyone for using stop loss, just telling you what I do. I also go pretty far out in time, right? So, you know, um, like for this Microsoft one, instead, if I wanted to buy the 515, it would have been more expensive, but I probably would have gone to October. Yes, more expensive. Actually, I probably, honestly, if I wanted to follow that, let's just say, is I probably would have done a diagonal where I would have bought a 500. Ignore my other strikes. I have covered calls here that I got screwed on. Buy the 500, sell the. Yeah, it's a little too expensive. But I would have done something like this, where I reduce my cost up front. It's but this is expensive. Like think about it. You're spending $1,000 for probably roughly $250 of upside. It's a little too expensive. Not a good example of it. I don't know if you know what I'm talking about when I say diagonal. We can look at it closer if you'd like me to. I do them quite a bit. I like diagonals. If I'm going to go debit trade. That expect butterflies are nice. Curious with your strategy. Good to know. It's good. I'm not sure what diagonal is. Thank you again for all the help with this. Of course, of course. Curious with your strategy. What's the average percentage per month you're increasing? So it's really hard for me to have historics with it because I have everything tied up in one account where I have my options portfolio, I have my long stock portfolio. I got everything tied up in here. So, my gain month to month isn't just options, so it's not fair for me to look at that. I did this with someone earlier, and I would say year to date, I made about a 10% return roughly, just options, and using my full portfolio value. So I used my full portfolio value and then only used the gains from options trading, and it was roughly 10%. Year to date, not month to month. So let's just say it was 8 months, about 1% or 2 per month. If you look at my trades, the ones that I'm alerting, there are other ones I haven't been alerting, but I'm going to change that up now. While we look at, like, I've done this since the end of June. Yes, the end of June, and my return is about 9%, 8.5%, and that's been 2 months. So that's 4% return, roughly, per month. There's going to be some losses that are going to hit soon, though. Yeah, there's going to be some losses coming up into September. But the main part of what I do isn't necessarily over trading, but the number of entries in the market in an intelligent way, of course, not over trading, but like, Tasty Trade kind of says roughly 2/3 of your trades are going to be winners. And so it's about managing the 1/3. But if I have 1,000 trades in a year, which apparently is the average number a Tasty Trade user does, 2/3 of those being winners is going to be a much higher number than if I had 10 trades in a year and 2/3 were winners. It's, my whole thing is using probability and statistics roughly to help make decisions. I'm not using technical analysis. I'll use it to help me. And, I'll say, hey, in my group here, I'll talk with mate G, and he'll say, oh, I see this on the chart or whatever, which gives me some confidence, but most of the time I just kind of follow my own, what I feel. Most of the time I take profit pretty quick. Could be taking profit too early sometimes, but I'd rather that than have a winner turn to a loser. Working on sitting in a little bit sometimes more. We got some losers coming in soon here this month. We'll see. Could you cover what a diagonal is? Yes, I can. Okay, I'll get to that second paragraph. Let's look at a diagonal just to show you. I have one on in applied materials. So a diagonal is, now when I did this, it was slightly different. That's about there. Is buying, now I would do this probably differently now, but you buy a long call in a longer dated expiration and then sell a short-term call at a higher strike at a shorter expiration. So if we were to structure one today, let's use a cheap stock so that it's not too expensive. Let's see, let's use IBIT. Wait, let's use one with low IV. What's a good one? Cheapy, low IV. We'll look at SoFi. How's that? Okay. So with SoFi, if I was to open a diagonal today, I would probably go to November for the long, buy this 26. IV's a little high in here, but IV ranks a little low, so we'll see. It might not be cheap. But I would open these up in a low IV environment because IV's mean reverting, like I said earlier. So if I'm going to open a trade in a low IV environment, I'd rather do a debit trade because if IV expands, it helps the trade. So I would buy the 26 in November, and then in October, I look for roughly a 20 delta, but I kind of just decide with money, risk reward. So in this case, roughly, it's $5 wide. I'm paying $244. So roughly, now it's not exact science, but roughly, I own some shares of SoFi, so that's why it's going to look like that. But roughly, you see here, this isn't exact, that it's about a 1-for-1. I could make 256, and I'm spending 244 to do that. This is a diagonal. The thing is that you actually can make a little bit more than 256 because if this starts going past 30, you can actually make a little more money than the width of the spread because the extrinsic value in this is going to be greater than the extrinsic value in the short. But if you get too far, it's going to flatten out. So you can make a little bit more than, but I like to use it as a general guideline of what I could roughly make. I hope that answers diagonals for you. If not, ask more questions. Do you want to ask that first before we do the IRA? If that was clear, of course, Suicide Baptist. I hope you, yeah. You let me know. Oh, you're messing DMing me? Just a minute here. You sent that, yeah. It's okay. Don't worry about it. Yes, I will read it. You don't have to retype it. So buy a call with a lower strike and further out, and sell a call with a higher strike that is closer. Is this mainly to offset premium? Yes, correct. It's to offset premium, and don't worry about it. It's to offset the premium. I mean, it's one of those things where you can always just buy the long and leave it, but at least if you're wrong, you saved yourself some money. You know. But yeah, it's basically what you're doing. I mean, you can always roll this. You can always go higher up if you wanted to. Like you could to spend less money, but of course caps your gain, right? Like you could spend 200, but max gain of 100 about. But yeah, that's mostly what you're doing is reducing your premium paid up front. And the nice thing is that if this starts not doing what you want, you can always roll this into a vertical if you wanted to, or you close or allow this 31 to expire. And then if it was worth it, you can go into November at a later date and sell the 31 in November against it to get a little extra premium out of it or to reduce your debit paid. Is that clear on there, or is there more questions to that before I get into your other question here? Okay, great. You're welcome. No problem. Thanks for asking questions because I don't think Mr. Galaxy, Blaze Ray, or Etai are here, so it's just you and me. Also, I know that I had asked you directly about doing these trades in IRA or individuals. Spreads are out for the IRA I see. Only in Robinhood. I don't know about other ones. I know in Tasty Trade, just to let you know, I can do IRAs. Or I can do spreads in my IRA if I move my IRA, but my IRA is in Robinhood at the moment. Hey, no problem, Blaze Ray. Um, but I've been doing riskier stuff in my individual, which seems counterintuitive since I'd like to be able to use the profits. And my IRA is the advantage split for ETFs. Do you have a philosophy on that? Basically, you asking, do I have a philosophy on doing riskier stuff in your IRA versus doing riskier stuff in your brokerage or individual? Is that what you're asking? I think it's a good question. I mean, I definitely I did some slightly riskier stuff in my IRA and it's paid off. Like I bought MSTR at a very, 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 very cheap price, and I got lucky. Um, do I wish that that was in my individual and I could have those profits sooner? Yeah, but I'll let it sit. I bought it before the 10-to-1 split. I got very lucky on MSTR. Um, so it's a good question. I think I think it's fair to just balance it out, feel it feels right. I mean, I do risky stuff in my individual. My IRA I treat kind of as a buy and hold. Once I move my IRA out of Robinhood, which I will do eventually, I might start doing more active options trading in there because Tasty Trade allows spreads in your IRA, which a lot of brokers don't. And like for example, my MSTR shares, I'd be happy now to maybe do Jade Lizards on them or other things instead of just plain vanilla covered calls, just to kind of play around with some shares and maybe lock in some profits on there. I'd say it's kind of a matter of what you want to do, right? I think there's nothing wrong with being risky in both because, like you said, you want to play with the profits. Well, if you're risky and it pays off in your individual, you do get those profits today, right? Then, of course, if you're risky and it doesn't pay off, you lose out, right? Yeah, I'm 35. You're pretty young. It comes down to risk tolerance for sure. I think it's good though to be conscious of your risk because yeah, if you play it too safe, you're going to miss out on a lot, right? So you want to have a good balance with it. But you're young, you're 28, you know. I mean, I'm young, I'm 35 and I'm young. So, I think, you just have to sit with it. I think the important thing is if you're going to start scaling, like we talked about, where don't necessarily just increase the number of contracts, increase the width of that spread, increase your deltas. So let's just say it's SoFi, and you wanted to sell a put in SoFi, and you normally air for a 20 delta. Well, maybe you start going for the 27 delta. Get a little more premium, take a little more risk, assuming you're happy with owning it, of course. That's a way to kind of do it. Were you here when I discussed the percentages that I kind of roughly follow? This is new. Were you here when I said that, like what you should do according to your portfolio? I think it might have been you or not regarding delta. It was that um, you want to do about 1 to 3% of your portfolio, like so using your portfolio value as a guide. Only open trades in the 1 to 3% range for defined risk, and up to 5% for undefined risk. Yeah, you were here. Okay. So, I mean, that's a way to think about taking on more risk too. Is if you're erring on the safe side and opening 1%ers, maybe go for 3%. But always, always try to, when scaling, don't go for contracts off the bat. Increase deltas, increase the width of the spread. That's going to pay off better. Increasing the contracts, yeah, it can amplify gains, but amplifies losses. And, like if you think about it, if you have, 10 $1 with credit spreads, well, your break even's super low, right? Your break even's 20 80 77, right? Whereas if you did, $10 wide, this might not be a great example. Yeah, it's not a great example, but now your break even's like 20, right? It's not great. This is a cheap. It's not a great example, but you can always roll up, right? You can always do 24, 14. Yeah, I mean, so then you're getting $2. Your break even's 20. I think you get what I'm saying. SoFi is probably not a great example for a put credit spread. And I don't know where are you. I don't know how much money you're playing with. I mean, I think, let's say you're under 100K, you probably want to err on the side of more defined risk. Maybe under 50K, you probably want to err on the side of more defined risk. When you start getting to that 6 figures, then you can err on the side of more undefined risk. But having a good balance of both, because the nice thing with some defined risk positions, especially if they're debit trades, is that your upside's pretty nice. Yeah, so 30K, you might want to err on the side of defined risk like you're doing. But you could throw in some undefined risk like a naked put or cash secured put, stuff like that. Good to know the deltas rather than the contract. Off topic, since you were early to MSTR, what are your thoughts on MTPLF? Honestly, don't really know. I know people love them. They are over the counter is the only thing that gets my attention. And so because they're over the counter, like my broker doesn't sell them, Robinhood doesn't sell them. So I have no way to get in unless I was to use my Fidelity account. But I see them all over Robinhood, or yeah, people are talking about it on After Hour all the time. I think people believe that is going to be the next MSTR. And so, they're pretty cheap. If you want to throw some money at it, you want to throw some money at it, no big deal. It's about if you're willing to risk it, Also, I was considering buying some MSTR leaks. Premium is absurd. Would you recommend doing that, or would I be better off buying as many shares as I can? Curious what you recommend. So, good question on MSTR. MSTR, expensive, high premium. Sorry, high implied volatility. You see it's 80s, 100s. Of course, the IV ranks relatively low, which tells you something. But like if you look at a leap, let's just say you were going to go to January 27, like a 70, yeah, it's going to cost you 11 grand, almost 12 grand. So, if you were really long-term bullish, that's where you could look at the synthetic stock, maybe, it's a small credit, but you could do 345 and get a little more. You know, 550 bucks today. Uses 5K of buying power, 40% pop. Basically, buying shares. Buying shares is 50%. I mean, it's an option if you're bullish on them, or that risk reversal. It's hard with me, when I get into stocks early, I get hard with like, well, it feels overvalued now. You know what I mean? It's like, well, shit, this feels overvalued to me. But that's kind of just biased nature of the stock, right? Yeah, I'd say, yeah, I mean, it would depend, right? Like, so that's the hard thing about you saying rolling these. Like, if this goes in your favor and you're at like $400, like, do you just close out, take the profits, and move on, or do you roll? I think you could roll it out, and then yeah, to pay attention to your delta and make sure you're staying at 100 deltas. And I mean, the way to really look at that is to eye the 50 deltas on either side here. That's really going to help you to remember to know if you're going to get about 100 deltas. But yeah, the synthetic longs are nice. No capital up front. You are tying up capital, so you might not want to do it too long term. But yeah, I think I've never rolled a synthetic. I've only ever bought them and closed them. Um, but hey, there's nothing. It's not a terrible way to approach it, assuming that you're directionally correct the whole time. Do you mean strike or expiration date? Strike. Okay, so if I was looking at this, let's just say, and I'm going to go to November, give myself a little bit more time. Let's just say, um, now it depends on your buying power. Um, you could go to the 340, but you're not getting paid very much, which is not great, right? But you're at least getting paid something. If you feel good about MSTR, I kind of like the 345 since you're getting 550 bucks, a little longer delta. And then you look effectively what's your cost basis. You're looking at what, 330, it's just under 335 then, right? No, just under 340. Yeah, 339.50. I mean, it's about $100 over. Whereas if you looked at the 40 minus 70, you're looking at 339.30. It's about the same. I mean, I'd say the 340 probably. Depends how bullish you are. Can we do December? That's probably what I would opt for. Yeah, sure, we can look at December. Sorry, didn't see you. So we look at December and we just go for the 340. Let's just see. It's a debit, so I would not recommend. If we go to 345, 438 credit, 101 deltas. I mean, yeah, if you're willing to tie up the capital, it's not a bad trade. I mean, it's good to have a selling component in this because of the high implied volatility. Um, and like we talked about, another option is to go a little out of the money on the put and a little out of the money on the call for the risk reversal and try to make it route for a credit instead of a debit. Um, all right, see you, Blaze Ray. Trivia tomorrow, 1 o'clock. Yeah, you're welcome. Of course, thanks for hopping in. You're bullish on Bob Dog Seeds crypto rally. Yeah, hey, nothing wrong with that. No. So if we look at risk reversal here, it is not. Your upside is unlimited. Max profit's unlimited. So it's just a matter of structuring this in a way where you're happy with the put and the call that you're buying, right? It'd be nice to route it for a credit. You could even go like 335, go for the 350 maybe and get a credit. Yeah, I mean, you get $1.42. Like you could play with it, and then that way you're tying up a little less capital in the short put. I mean, you could even have a short put and a long call and a different expiration. Like you could have this long call and a shorter date expiration. It's not great though. That's a good question. I think it's all about what you want to do. I personally, just to give you an example, in bowl, just to show you, in bowl, I did a synthetic long earlier this year in June. Closed it out very quickly for 150 bucks. Could have made more, and then I decided to get back in and do a risk reversal. And in this risk reversal, what I did is I went to January and I sold two of the 250s, bought one of the 20s. And I routed this for $2.20 credit. It's been very hard for this to get money out. And I tied up the short put for a while. Um, the one nice thing about this trade is that if it keeps on going up, you could technically close out this short put for hopefully net zero, and then you have a free long call, which is nice. Um, I'd say, though, in terms of high implied volatility, either one plays with high implied volatility since you were selling a put involved in there, right? Like either way, you're playing into the high IV, right? You see, like, all this really contract. Anyways, I'm not nervous about this one. If I have to buy bull, I have to buy bull, or I'll roll it out. But yeah, I have a trade on for Ethereum, ETHA, that's bullish. I have a short strangle in IBIT that I've been rolling and playing with. Currently have a net premium on IBIT. It says 657, but there's an old trade that's including this at 770. I've just been rolling and playing with the short strangle in IBIT. Ethereum A, I did something. We can talk about that in a minute. Okay, so for something like this, I suppose you could do a December call and then sell monthly puts to get that premium down. Is that the idea there? Yeah, so that's something that might be the better move because, like, we look at Bull here. If I just bought this call at 20, now, of course, the price was different, but let's just say it was 90 bucks. If I did that and then short term, like 20, sold puts at the strike I was happy with, then I'm going to whittle down that slower, tie up this capital for less time in the put, and then eventually this could be a free long call like you just talked about. So that might be a better way. I mean, you're treating it almost like a poor man's covered call, except you're selling puts against it instead of selling covered calls against it. So I think that's a fine way to look at it too. I mean, the only problem is if you start to get tested on that put, then you're kind of doubling down. But hey, you could roll it. You can play with it. You want to be careful because you have a $30,000 account. MSTR might tie up a lot of your capital, so you want to be aware of that, right? Your buying power will get tied up in one trade, and you might not want that. Yeah, doubling down. So you might want to look at something, just to let you know. I know what Bob Dog recommended, but you can look at IBIT, much cheaper stock. It's in the 60s. It's at 40s, but it's got pretty good IV. Um, so it's something you could look at, like selling the puts. And for me, I go around. I usually start around where the end of the expected move is. So like if I was looking at this, and then I'd also look at implied volatility, or excuse me, open interest and volume. Like if I was looking at this now, if I was super bullish, you could go down to the 60 if you wanted. And then like do a long term, just say January, and you wanted to buy the 70. Oops. do something like this, 270 debit, then you could roll that put as you go. It's not an option. Oh, sorry, was I breaking up? My bad. I was further away. What part did you hear what I was saying about using maybe IBIT over MSTR? Okay. So, is this better? Sometimes I am talking. Okay. Yeah, I'm holding the mic, so that helps. Yeah, I was saying like for the delta, I usually err for like around the end of the expected move. Yeah, let's clear this out. Sorry. So, I'd err for like a 25 here. I'm also looking at open interest and volume. But because of that and all that being said, maybe I'd go to the 60 if I was really bullish because, yeah, it's a higher delta, but look at the volume and open interest, very high here. Getting a little more premium. And then I'd say you could do the leap based on your own risk tolerance. But at least this would be a little bit cheaper for you and tie up less of your capital, where that's going to tie up, I don't know what your broker would do, but 5K, $500 or five to 6K worst case. And then, you could buy like an $80 put or call, excuse me. You could route that for a credit. Now, of course, you might want to do a little closer up, but at least that's routed for a credit. You don't tie up this put for too long. Was that what you need to repeat it, or is it something else? Okay, you're welcome. Well, I got about 10 more minutes, and so you got more questions, go ahead. I try to do these about every week. I think I might move them to Thursdays instead of Fridays. Just FYI, since I know you're newer. Happy to have you in here and answer questions. This is my time, and I do it for about 2 hours every week. Um, yeah. And then, of course, if you're done for today, we can be done for today. It's up to you. You are good to go. Don't apologize because, like, as you saw, if there were a lot of people asking questions, you would have known. No one was holding back because you were asking questions. Don't worry about it. Um, and this is what's here for. It's for, sometimes I have just one person, I'm just helping them. As you saw, we had a good amount of people. Actually, I think the most people I've ever had in here. But yeah, but I'll keep it updated. See, I think, like I said, I think I might move these to Thursdays, but I'll be announcing them and all of that. Happy to have you in here. And yeah, we can keep doing it. And you'll see as this gets more busy, maybe we air for a different way to answer your questions. Well, happy to have you in here. I'm glad. Yeah, you're welcome. I'm glad that I wasn't gonna message on after hour to tell you, hey, I haven't changed the price yet because I felt like I was poaching from David. But hey, happy to do it. Happy to give you a deal, and you're locked in on that price. So